Hello. Welcome to another Cape Cod Real Estate Corner. Our guest is Mrs. Claudette Vickery, the New England Regional Mortgage Lending Division Manager for a major regional bank. Claudette lives in Hyannisport and has an office on North Street in Hyannis. Mrs. Vickery is the owner and hostess of the Cape Cod Real Estate Show on News Radio 95.1 WXTK on Saturday mornings from 10 to 11. Mrs. Vickery is going to talk about a home of your own and the credit programs that are available to you. Welcome to the Cape Cod Real Estate Corner, Claudette.
Thank you, Bob. It's a pleasure to be here. A home of your own, perhaps the largest purchase you will ever make. It's very important to understand options. Options are the key here, and programs vary. So let's talk about what those options could be. First-time buyer programs, affordable mortgage programs, regular fixed conforming programs, and last but certainly not least, FHA and FHA loan. So as far as conforming loans go, typically there's a requirement of a down payment for a lot of the programs. Conforming mortgage, Bob, is 5%. So if you have 5% down, and you're not a first-time home buyer, you may want to definitely explore that option. If you have less than 5% down, then there are a couple of things that you want to really analyze and ask yourself. Are you a first-time home buyer? Now, there's a theory out there that a first-time home buyer is someone who's buying a home for the first time, but that's really not true to form. A first-time home owner classification is really a person who has not owned a home in the last 3 years. If you haven't owned a home in the last 3 years, but you've owned one previously, you may still qualify for the first-time homebuyer program if you meet all of the criteria within that program itself. So it's pretty interesting. So again, if you have owned a home, it's been a 3-year time period, you will be considered a first-time homebuyer. You just need to meet the criteria of those programs. So first-time homebuyer programs. One of my favorite and really the one that I regard as the best one out there if you qualify is called the Mass Housing Partnership Program. And the Mass Housing Partnership Program is a state subsidized program in Massachusetts, and it allows you to purchase a home, and it really has a requirement of income. It's an income driven program. So in Barnstable, if you are a household of one, if you make $56,210 or less, you'd qualify for the Mass Housing Partnership Program. If you are a family, a household of two, $64,240. If you're a household of three, $72,270. So why is that important? Why is a Mass Housing Partnership Program important or different? And why would you want to elect to do a Mass Housing Partnership Program over a fixed rate program? Couple of things. Interest rate. Usually the Mass Housing Partnership Program is about 0.25% less than what a 30-year fixed conforming rate is. And on a mortgage over a 30-year time frame, that's a lot of money that you're spending. The other thing is the down payment requirement. A fixed conforming requires 5% down. The Mass Housing Partnership Program requires 3% down. Only 3% down, for which 1.5% needs to be your own money. The other 1.5% can come from a gift or a family member, or if you're eligible, you may qualify for down payment and closing cost assistance. So again, Mass Housing Partnership Program, it's an income-driven program. It is qualified on the number that are in your household. It goes from county to county. So if you're thinking about Plymouth County versus Barnstable County, those figures that I just gave you relative to income is going to be a lot different. Or if you're in Boston or any of the surrounding counties. So let's just say that you don't qualify for the Mass Housing Partnership Program. Let me go back. Mass Housing Partnership Program. When you put less than 20% down on a mortgage, you are required to pay private mortgage insurance. Private mortgage insurance is an insurance that is required for anyone who puts less than 20% down. And that protects the lender in the event that you default. So that's an extra payment every month that you pay above and beyond your principal and interest, your taxes, and your insurance. And you pay that for a period of time until the house has a value, or depending upon the program, you may have to refinance to actually drop that. So Mass Housing Partnership Program requires 3% down. There is no private mortgage insurance. The interest rate is 0.25% less than a fixed conforming rate. Fixed conforming rate requires a minimum of 5% down. The interest rate is usually 0.25% higher or more, depending upon your credit score. If your credit score is less than 740, that interest rate will be higher than that 0.25% that we just talked about. And again, less than 20% down, you're required to pay private mortgage insurance. The second program, if you don't qualify for a Mass Housing Partnership Program and you are a first-time home buyer, is called an affordable mortgage program. And an affordable mortgage program is a program that will allow anybody within the income limit to qualify as long as you don't own another home. So it's an affordable mortgage program. You do not have to be a first-time home buyer. You just simply cannot own another property when you apply. The income limit for Barnstable County for a household is $64,240. So if you're $64,240 or below, you would qualify for this affordable mortgage program. Again, that interest rate currently is 0.25% less than a fixed rate conforming loan. It does require private mortgage insurance. The requirement for the down payment on the affordable is the same as the Mass Housing Partnership Program, 3% down. That 3% needs to be your own money, not 1.5% like Mass Housing Partnership, 3% down of your own money. Requires private mortgage insurance. Private mortgage insurance, again, is that insurance that protects the lender in the event that you default. On this particular program, you're paying that private mortgage insurance until you reach the equity level that's required so that you can drop it. Once you reach 20% equity in the home, you can ask an appraiser to appraise your property, and if the appraisal comes in where it needs to be relative to the bank requirement, you will be able to eliminate that. It goes away. You don't have to change your loan, okay? Mass Housing Partnership, you don't have to even worry about that because there is no PMI, so that's a big savings. There is another program called FHA, and that FHA program requires 3.5% down. And the difference between the FHA and the other programs that I just spoke about is significant. It's not a bad program. The interest rate is relatively similar to the fixed conforming rate. However, there are two things that are required: upfront private mortgage insurance and private mortgage insurance. What is upfront mortgage insurance? Upfront mortgage insurance is a premium that's required by FHA that you have to pay from the get-go, right up front. And it's significant. It can be significant. I'm going to tell you how significant it is. If we take a $275,000 home purchase and you put down 3.5% of your money, down payment, as far as FHA goes, you're going to be borrowing a mortgage of $265,375. Upfront private mortgage insurance that you need to pay is going to be $4,644.06. That's in addition to what you're paying for the home. So it's an extra cost. You can roll that into the cost of financing, but it's still an extra cost. You're still paying it, whether it's out of pocket or you're paying it over the life of your loan. The private mortgage insurance that is required on FHA cannot be discounted or cannot be waived after you reach the equity limit. You are required to carry that until you refinance out of that. Some people will say, okay, so what's the problem with that? Well, there's not really a problem, but there's a cost factor here. Every time you refinance, it's going to cost you money. So again, FHA is different because you're required to pay that upfront private mortgage insurance. You're required to pay the monthly mortgage insurance, And when you have the equity in the home, you can't call an appraiser, get an appraisal, and ask the lender to actually eliminate it. It just won't happen. Another cost involved, refinancing out of it. So that in and of itself are programs that you need to consider when you are purchasing that home. And a couple of the things that your lender is going to do when they are qualifying you is they're going to base it on a couple of things. One, your credit score, and two, your debt to income ratio. What is debt to income ratio? Debt to income ratio is your monthly debt divided into your gross monthly income, and that gives you what is called debt to income. It'll give the lender a percentage rate. So let's just say that you make $50,000 a year, so that means your gross monthly income would be about $4,166. And so when you take your principal, your interest, your taxes, and your insurance, you're going to divide that principal, interest, taxes, and insurance. And I'll give you an example. Under the Mass Housing Partnership Program, on a $275,000 purchase, 3% down, you're going to be borrowing $266,750. Your interest rate current today is going to be $1,179.29. So that's your principal and interest payment. Taxes we estimate at about $100 a month, and insurance we'll estimate at about $100 a month just for the purposes of easy figuring. And so you're looking at really $1,379.29. So you take your $1,379.29 and you divide that into your gross monthly income, $4,166, and you get a ratio, and that's your housing ratio. So then, as far as getting your total debt to income ratio, you're looking at all of the payments that you're paying every month. So if you have an auto loan for $200 and you have a credit card payment for $100 and you have a student loan for $200, you're going to add that to your housing expense. You're going to take that total, you're going to divide it into your gross monthly earnings, and that's going to be your debt to income ratio. So on an FHA, your debt to income ratio is allowed at 50%, believe it or not. Now on first-time homebuyer programs, you may be limited to only 40%. So while you may qualify for a Mass Housing Partnership Program on the income and on the credit factor, you may not qualify because you've got too much debt on the other end. So there are a couple of things that you can do. If you have money, we can pay down some debt or pay off some debt. Or if mom and dad want to give you an early Christmas present and pay off your credit card, you can ask for that too. But there are a lot of ways to understand where you are in the grand scheme of things. A good lender is going to give you a very nice, easy to read option page. It's going to say 30-year fixed conforming, it's going to say Mass Housing Partnership Program, Affordable Mortgage Program, FHA Program, and any other programs that they have to offer you. A good lender will tell you, here's your credit score. One line across under all programs, this is what you need to qualify for this program. This is what you need for debt to income ratio on these programs. So you can actually look at this grid and you can see they do not qualify for this because they're over the income limit. They do not qualify for this one because they're under the credit score requirement. So in a snapshot, at a glance, you understand unequivocally what you qualify for. Now, when you go into a lender, some of you may be able to go into a lender and right away take that pre-approval and go out and buy a house. Others may have to, one, work on your credit, work on your debt to income ratio and consolidate some debt, or do some other things, save a little bit more cash for the down payment, because instead of qualifying for the fixed rate conforming, requiring 5% down, you qualify for MHP, so you're going to work towards getting your debt to income ratio down because that's a program that you want. So something like this piece of paper, this pre-approval or option page at a glance, is a real tremendous thing for you to have in your hands so that you can make the decision that's best for you. A home of your own. A home of your own. Perhaps the largest purchase that you'll ever make. So make sure that you understand what your options are and make sure that you choose the program that you think is the best program for you, because that's going to make all the difference in the world. And when you take the interest rate differential and you take the cost differential and you multiply that over a 30-year period, that savings adds up. So again, a home of your own, perhaps the largest purchase you will ever make. Make sure that you find a realtor who you can count on and who you can trust. And be sure to find a lender you can count on and you can trust, because that lender is going to be a critical piece of that home purchase that you're going to make. So when you receive the keys, you will be very, very happy with the decisions that you've made. A home of your own, perhaps the biggest purchase you will ever make. Find the right lender, find the right realtor, interview them. Don't just walk into any lending institution and think that you have to deal with the person who's sitting at the mortgage desk, because you don't. Everyone has options, exercise them, and make sure you find the mortgage that's right for you. Thank you for listening to the show tonight. I hope to talk to you soon.
Thank you very much, Claudette. Very interesting. And thank you to our audience. We look forward to having you tune in again for the next Cape Cod Real Estate Corner on Channel 99.